Executive English, Bond Yields for Equity Morning Calls. Welcome. Today we're making bond yields equity friendly. If you run stocks, you still need a quick grip on rates, because yields quietly move valuations, sector leadership, and daily risk appetite. We'll connect rate moves to what matters for portfolios, multiples, style tilts, and communication with clients. Expect plain language, crisp examples, and phrases you can use in notes or meetings. By the end, you'll explain, in seconds, why a yield move happened, what it means for growth versus value, and how to position without drowning in bond jargon. Start with the basics. Yield is the return investors demand. When price goes up, yield usually goes down, and vice versa. A coupon is the bond's fixed interest payment. Think of it as the salary. The yield is the salary relative to today's price. The curve shows yields from short to long maturities. Duration measures price sensitivity to yield changes. Higher duration equals bigger swings. Term premium is the extra yield for locking money up longer. Nominal yields include inflation. Real yields strip it out. Real yields matter for stocks because they reflect the true hurdle rate for future cash flows. When yields rise, the discount rate used in valuation rises too, so multiples compress. Prices pay less for the same earnings. That hurts companies priced on far-out profits. Higher yields often favor value in financials. Banks can benefit from better net interest margins, and value names rely more on near-term cash flows. Lower yields typically boost growth and long-duration assets. Think software and high-multiple innovators, because future earnings look more valuable when the hurdle rate falls. Always link yield direction to where cash flows sit on the timeline and how sensitive sectors are to funding costs. First, state magnitude and direction. The 10-year yield is up 7 bits per second, and name the tenor, 2s, 10s, 30s. Then give drivers, fresh economic data, Fed commentary, Treasury supply, or global risk shifts. Keep it plain. Stronger jobs data lifted yields. Add a tone word to guide interpretation. Edging, small, steady, surging. Fast, notable. Stabilizing. Pause after moves. Finish with the equity angle. Higher discount rates are weighing on growth. Value is outperforming. This tight frame turns rate noise into a clear equity signal. Curve changes tell you where the pressure is. Bear steepening, yields rise more in the long end, often on growth or supply worries, pressuring long-duration equities. Bull steepening, yields fall more in the long end, relief for growth. Flattening means the gap between short and long narrows. It can be bear, shorts up, or bull, longs down. Watch the 2/10 spread. Deep, persistent inversion can flag recession risk. For equities, steeper curves can aid cyclicals like banks and energy, while flattening or inversion often pushes investors toward defensives such as utilities, staples, and healthcare. Focus on real yields as the market's true hurdle rate. When real yields rise, financial conditions tighten, borrowing costs bite, risk premiums widen, and equity multiples face pressure. The most exposed areas are speculative or long-duration tech, where value rests in distant cash flows. In these periods, investors often rotate toward quality, steady cash generators, or defensives. Assets like gold can act as a buffer when real yields fall or when uncertainty spikes, while defensives help cushion portfolios when real yields firm and the market demands more immediate, reliable earnings. Translate quickly. The 10-year is up 8 bits per second on a hot CPI, means inflation surprised higher, pushing yields up. Equity implication: higher discount rates today, which pressures long-duration growth and supports value, financials, and cash-rich quality. What to do? Tilt towards sectors with cash flows today: banks, energy, select industrials, and trim high multiple names until yields stabilize. If the move fades, you can reassess growth exposure. Keep the message crisp: what moved, why it moved, how it changes valuations, and where you prefer to allocate right now. Use clear, confident lines your clients remember. Try: yields are repricing growth and policy after today's data. Or, multiples compress as reals grind higher. We're leaning into quality cash flows. For sector color, curve steepening favors banks and energy given better carry and reflation tone. And for risk stance, we'd fade high beta on firmer reals until the hurdle rate eases. These phrases translate bond dynamics into actionable equity guidance. Short, specific, and easy to reuse in notes, calls, or quick updates.